Good afternoon, everybody. How are you guys doing today? Good afternoon. Good afternoon. Oh, let's get a little light on here. Good afternoon, everyone. How y'all doing today? How y'all doing? Got a little bit of information to share with y'all today, and then, for anybody that's interested, I might go ahead and post the some IRS reading for you guys if you're interested in that. But how's everybody doing today? How's everybody doing today? We're gonna give it a couple minutes, let people get on in here, and then, once we get some people in here, a few more people, we'll go ahead and get started. This is another video that I'll be saving, so people that come in late will be able to review this video at a later time. All right. So we're going to go ahead and get started. We're going to go ahead and get started a little bit here. So this is another hashtag get real woke type situation. This is another hashtag for the free educational discussion. How you doing, Colette? It's another educational discussion. Today we're going to talk about understanding banking and investment accounts. So now that we've covered majority of the things that I wanted to cover in understanding credit, now we're going to move on. So today we're going to talk about understanding the different types of banking and investment accounts that are out there. Now understand that there are a number of different types of accounts that you can have, right? And there's several different names for them and things of that nature. What I'm primarily focused on today are accounts that are specific to what the average consumer would be dealing with, right? So we're going to talk about banking and investment accounts, and we're going to focus specifically on accounts that the average consumer would be looking at for this situation, okay? So let's go ahead and get started, okay? Let's get started. So first of all, when you understand this, you got to understand that there overall, no matter how you cut it, there are only two types of accounts, right? There are only two account types overall. Now, there are many different types of accounts that fit under these two account types, but there really are only two account types overall. And what are those two account types? Okay, so the first account type is what's called a current account, right? And what is a current account? A current account is a bank account by which your bank account balance is available to you on demand. These accounts typically have debit cards, checks, and can be withdrawn from via an ATM machine. Okay, so that's called a current account, right? And it's very important that you understand that that is a current account. Like, a current account is anything that you can access your money from at any time with minimal issues, right? It has a debit card or one of those check debit cards. I got some checks. You can write a check on it. You can get the money out of an ATM machine. These are known as current accounts. Now, the other type of account is a timed account. What is a timed account? A timed account is an account where deposits that are placed there are restricted from withdrawal for a period of time. You cannot withdraw from these accounts earlier than the specific period of time, right? Without paying a penalty for the early withdrawal. Generally, these types of accounts do not have debit cards, do not have checks, and can't be withdrawn from via an ATM machine, right? So timed accounts, when you put your money in a timed account, your money is supposed to be locked up in that account for a specific period of time. And if you try to access that money before that specific period of time, then in order to get the money, you usually pay some substantial fees, penalties, things like that, because you're accessing the money earlier than you would really supposed to be accessing it based on what you put it there for, right? So let's walk into that. Okay, now, so now let's talk about some of the different types of current bank accounts, right? What are the different types of current bank accounts? So when you get into current bank accounts, right, we talk about checking accounts, right? So one type of current bank account is a checking account. A checking account is that's what most of you guys have every day. I'm sure most everybody in here has a checking account. A checking account is where many people deposit their pay and keep their day-to-day spending money. Generally, right, a checking account comes with checks and a debit card, which you can use to spend the money that's in your account, right? Some checking accounts have a monthly maintenance fee if you don't meet certain requirements, such as maintaining a minimum balance or having a direct deposit into an account each month, right? Checking accounts also generally don't offer a high interest rate on the money you keep in the checking account, although there are exceptions for online-only accounts and high-yield checking accounts. But again, when it comes to these high-yield checking accounts, you got to understand that you got to have like a larger minimum balance or a larger average balance to be able to avoid the fees. So there are different levels of checking accounts at different banks, and different banks call them different things and structure them into different tiers. Some banks have student-only checking accounts, right, where a student can bank at the bank for free. Some people have totally free checking. Totally free checking is there's no fees, there are no monthly maintenance fees, things like that. And but again, the interest rate's probably zero or very close to zero, right? Some banks have these checking accounts where as long as you establish a direct deposit with them, right, you won't have to pay their monthly maintenance fee. Their monthly maintenance fee is waived provided you have a direct deposit with them, right? So, there are different types of checking accounts. So for deposit accounts, the interest you earn will be displayed as an annual percentage yield, right? Which includes compounding the interest you earn on interest. You can use the APY to calculate how much you could earn in interest each year and compare these accounts, right? So we're going to get into APY at a later time. We're also going to get into compounded interest and how that works when we start talking about, different types of investments that are out there for you. We'll start talking about compounded interest and things like that, right? So we'll get to that at a later time. Now, so another type of, so everybody understands what a checking account is. I would assume everybody kind of understands what a checking account is, right? So, for a lot of you guys, this stuff may be like common knowledge, but I'm starting from the very, 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 very basics of this. So that way, when I work you guys into this, right, you'll really, truly understand what you're doing overall, and you'll really be able to make some things happen for yourself, right? So let's talk about savings accounts, right? So savings accounts are another type of current account, right? So savings accounts, keeping your savings in a separate account from your day-to-day spending money can help you avoid the temptation of spending the money, right? Savings accounts generally offer a higher interest rate than checking accounts, and it can be more difficult to spend the money that's in your account because you won't receive checks generally, and generally don't receive a check debit card that's directly tied to the savings account. That's not saying that you can't link the savings account to a check debit card that's tied to a checking account. It's not saying that. But generally, banks don't give out check debit cards on savings accounts, so it makes it a little bit more difficult to access the money if you really need it, because the idea of a savings account is to obviously save some money, right? And because of that, they pay a little bit better of an interest rate, right? So that's kind of what saving accounts are designed to do. Some banks still give debit cards, regular debit cards for their savings account, whereby you can go in and take money out of the ATM machine. And a lot of banks at this stage in the game are coming up with what they call withdrawal limits. The amount of times that you can go and withdraw money from a savings account without paying a fee, from the bank. So a lot of banks are going that direction now to encourage you to keep your money in there a little longer, right? So with that, you may have to pay a fee if you try to make more than 6 withdrawals or transfers from your savings account in 1 month, although there are exceptions for certain types of transactions, right? But overall, right, If you withdraw more than 6 times out of your savings account, generally you're going to pay a fee for that, right? Now, okay, let's talk about another type of current account. Another type of current account that you deal with at a bank account is a money market account, right? And money market accounts are a little bit different than savings accounts. So money market accounts, and they're sometimes called, right, and we'll talk about, respect the mindset so they can leverage it. We'll talk about fractionalized reserve banking. That's actually what we're going to talk about next week. I'm going to explain to you how fractionalized reserve banking works. But, so money market accounts. Money market accounts, sometimes also known as money market deposit accounts or MMDAs, right, are like a blend between a checking and a savings account. They're kind of hybrid, right? MMAs often offer a higher interest rate than a basic checking account or savings account, and they have a debit card or checks that make it easier to spend the money. However, as a type of savings account, the 6 withdrawal limit also applies to money market accounts, right? So it's kind of like a hybrid account, right? It's kind of like a cross between, a checking and a savings account in that, you may be able to get a debit card or check debit card. You may be able to get checks on the account, but you still have a 6 time withdrawal limit, on a monthly basis on that account. So it's kind of like a hybrid, right? Now, the other thing about money market accounts is this. See, money market accounts also often have a high initial minimum deposit requirement. Some go as low as $2,500. Some go a little lower than that, but some go as high as $25,000. And an equally high minimum daily balance requirement if you want to continue earning the high interest rate. So when you start putting money in a money market account, if you want to access that higher interest rate, of course, they have higher balance requirements, highly daily balance requirements, highly monthly balance requirements, higher average balance requirements. And if you don't maintain those requirements, then you're not able to take advantage of the stated interest that they would be willing to offer you if you did in your money market account. Some people open money market accounts and don't really understand all the requirements that are there for them to be able to gain the interest rate every year, and a little bit disappointed when they don't get that interest rate, but it's because they didn't meet the threshold requirements to be able to do that. Having a money market account is one thing. Being able to consistently meet the threshold requirements is another thing. So you always got to remember that when you're considering money market accounts, right? So, so those are the 3 types of primarily the 3 types of current banking accounts that you would be dealing with at the bank level. Now, let's talk about timed bank accounts. Okay, what's a timed bank account? So a good example of a timed bank account, and I saw somebody write it in here, is a certificate of a deposit, or a CD, right? So a certificate of deposit is a type of savings account that may offer a higher interest rate on your savings in exchange for agreeing to keep the money locked up with the financial institution for a specific period of time. CD terms may range from a few months to several years, and they offer higher rates if you choose a CD with a longer term. So if you allow the money to hold your bank for a long time, hold your money for a really long time, right? Then what happens is they're willing to pay you a little bit more money than that. That's a timed account, right? They're saying that, okay, if you get a 10-year CD, obviously you're going to make more interest in a 10-year CD than you will in a 6-month CD, for example. But, if you have watched my last video on this, I talked about using CDs only as leverage instruments and not standalone investments, right? So we talked about that because the interest rate just isn't enough, right? So, but again, this is an example of a timed account. So if you need money in your CD, you may be able to withdraw the funds and pay an early withdrawal penalty or fee. You see what I'm saying? So, you can access the money earlier if you would like. However, you're going to pay an early withdrawal penalty or fee to be able to do that. And so that's why it's a timed account. That's why they call it a timed account, because it's not so easy to access the money there. It's supposed to be locked up for a period of time, and if you want to access it early, you have to pay the bank some money to be able to access your money, right? Because you're messing up their leverage ratio. We'll get to that when we talk about fractionalized reserve banking. Okay, so that's really the only type of timed account that you're really going to see as a consumer on the banking side. The only real timed accounts that you guys would be seeing are certificate of deposit accounts. So I just kind of wanted to go over those with you. So now we're going to get into different types of investment accounts that consumers generally tend to run into. Give me a second, guys. I need a little water. Okay. So now, types of investment accounts, right? Now remember, I told you there are only two types of accounts overall. They're current accounts and timed accounts. So now that you understand the difference, as I run through the different types of investment accounts, you should be able to figure out if it's a timed account or a current account, right? So let's see. So the first type of investment account that we'll talk about is an individual brokerage account, right? So let's talk about an individual brokerage account, right? So individual brokerage accounts work like this. It's an individualized brokerage account is the most basic and flexible type of investment account, right? In the simplest terms, a brokerage account allows you to buy and sell investment vehicles through a licensed broker, like Merrill Lynch, like Charles Schwab, like places like that, right? With very little restrictions. So that's how it works, right? So an individual brokerage account, will allow you to, this is how you begin to access the stock market and the bonds market. You need a brokerage account to be able to do that. And you open brokerage accounts with, investment houses. And so that would be like, that's your Merrill Lynch's, that's your Morgan Stanley's, that's your TD Ameritrade's, that's your, there are tons of brokerage houses out there, right? So, but in order to invest in stocks and bonds and options, you need an individual brokerage account. So that's what you need. Now, and the same thing goes for index funds and the like. If you want to invest in index funds, you need an individual brokerage account. You must first have the account and have some money in the account to be able to then make the investments into the different types of investment vehicles that are out there, which we'll get into in a later part of our series. Now, so what are the key benefits? So what are the key benefits of having an individualized brokerage account? Let's cover that. So first of all, there are no contribution limits, right? So you put as much money in an individualized brokerage account that you want to put in there. Now, and there are no restrictions on withdrawing the funds from the individualized brokerage account. Now, let me dig into that a little bit. You can put as much money as you want to put in your brokerage account. That's fact. You can put as much as you want in there. However, if you only put $1, let's just say hypothetically, you only put $1 in your individualized brokerage account, well, you have money in the account, but if Apple stock costs $200, you don't have enough money in the account to be able to buy a share of Apple stock. So at the end of the day, right, while there's no contribution limits, let's be clear that if you're trying to invest in a specific thing or invest for a specific reason, or if you're trying to pick like an index fund, like an S&P 500 index fund, or there may be minimums depending on which company you go through and which fund you pick, right? Like Vanguard, T. Rowe Price, Fidelity, etc., right? There may be an investment minimum. They may say in order to get into our index fund, we need $2,500. You got to put $2,500 in the index fund. And in order to do that, you got to have $25 in your individual brokerage account. And if you don't have $2,500 in there, well, you can't get in, right? So, there's no restrictions on withdrawing the funds. In your individual brokerage account, you can move that money in and out as you see fit. However, once you begin to use that money to buy stocks and invest in index funds and things like that, then there may be withdrawal restrictions on being able to sell your interest or liquidate your interest in the stock or in the bond or in the index fund before that money is transferred back into your individualized brokerage account for you to move around as you see fit, right? So, that generally is how that works. So let's be very clear about that, right? So usually if it's a highly liquid stock, you can liquidate that pretty quickly. Some index funds say they want you in for 6 months, a year, before, you're able to get your money. Or if you get your money, it's going to come out with a penalty, right? So you have to read, again, it's all about reading documents. It's all about reading the fine print and understanding what the rules, policies, and procedures are for the things that you are investing in through your individualized brokerage account. The account, again, is only the first step, right? So you have to get the account. You gotta have an account to get in the game. You can't get in the game without an account, right? So, a lot of people say they want to buy stocks. A lot of people say they want to buy bonds. A lot of people say they want to get into index funds. my question generally tends to be, hey, do you have a brokerage account? Do you have a brokerage account? If you don't have a brokerage account, well, we got to start there first. Get yourself a brokerage account. Then, there's options for you to be able to do that. Anna asked me if I can break that down a little bit more. Sure. So, okay. There's 2 steps to making an investment in stocks, bonds, index funds, things like that. There are 2 steps, right? So there are 2 steps. Step 1 is, first of all, you have to have a brokerage account, right? An individualized brokerage account or a joint brokerage account. A joint brokerage account is, just an account you have with your spouse, right? Both your names are on it, right? So it's a joint brokerage account. Now, so you have to have a brokerage account first. That's first. That's before you can invest in a stock or bond, you must have a brokerage account. You cannot invest in a stock and bond without going through a brokerage firm. A firm that specializes in investments, right? Like an investment house, like investment banks, investment advisors, brokerage firms. Like, you have to have access to the market. They're the ones that give you access to the market, right? So you have to establish an account with them, right? And so that generally tends to be, for the common consumer, it's going to be TD Ameritrade, it's going to be Fidelity, it's going to be Merrill Lynch, it's going to be maybe Morgan Stanley, Charles Schwab. These are brokerage houses, right? And so you're going to establish an individualized brokerage account with them first. Now, once you have the account, right, now you're going to have access to the market. Now you're going to be able to log into that account and pick different types of stocks and bonds or index funds or exchange traded funds or options that you want to invest in through that account. So once you open the account, then you have to fund the account. You have to put money in the account, right, for the purpose of being able to make the investments in the things you want to invest in. So, for example, if you say, I want to buy Apple stock, and you see that Apple stock is trading at $200 a share, if you want to buy 1 share of Apple stock, you must first put $200 in your brokerage account and then invest it or pick the Apple stock, and then it will go into the Apple company. And now you own 1 share of Apple stock. You are now a proud owner in Apple. And we're going to talk about that week after next when I talk to you guys about equity and fixed income. This is going to crystallize when I talk about equity and fixed income. Anna, that's a great question. I'm actually going to talk about 401ks. You're talking about 401k, 403b, things like that. I'm going to actually get to that. Give me a second. So there are no restrictions on, 403b, right? It's the same thing. It's a retirement account. We're going to talk about that, right? So we're going to get there. Just give me a second. So now let's move a little further. There are no restrictions on withdrawing funds, right, from your brokerage account. Now, again, you have to, if you've invested in a stock, you got to sell the stock first. And then once you sell the stock, then the money comes back into your brokerage account. And then you can withdraw all the funds in your brokerage account if you want to and put them in a checking account. And you can do that. Like, it's up to you, right? So some brokerage accounts offer debit cards, check debit cards, that you can actually spend the money directly from the brokerage account if you got cash in there, right? You can't spend the money on the stock, you can't spend the money in the index fund, but once you sell your investment and that cash is back in your brokerage account, some, like I believe Merrill Edge has that. Merrill Edge actually has a debit card that you can actually use to spend the money in your brokerage account like your bank account. Now, here's the difference, right? Here's the difference. I want to talk about this, and I need to disclose this. There's a disclosure here that needs to be made. Bank accounts have FDIC insurance. Bank accounts have FDIC insurance. Remember those initial accounts we talked about, checking, savings, and money market accounts, right? CDs. These all have FDIC insurance backing them. However, once you open a brokerage account, understand that even though you may open it understand that even if you may open it, right, with a bank. Okay, let me explain it like this. Okay, Bank of America owns Merrill Lynch, right? Merrill Lynch is owned by Bank of America, but they are not the same company. Merrill Lynch is a brokerage house. Bank of America is a bank. Bank of America has a federal charter. Merrill Lynch does not. Merrill Lynch is registered as a broker-dealer with the Securities and Exchange Commission. They're covered under FINRA and SIPC. They're registered, they're regulated by FINRA, but they have what's called SIPC insurance, Securities Investor Protection Corporation. I need to get into this, and I didn't even put this in my notes today. I usually write an outline for you guys. I didn't put this in my outline, but I just thought about it right now. I need to talk about this. FDIC insurance covers your bank accounts up to $250,000 at this point, right? There is no such thing in the brokerage world. When you have a brokerage account, that is not covered under FDIC insurance. You can lose if you make investments that are poor investments. You are then at that point, right, subject to losing all of your money in the stock market. It's possible. If you make bad investments from your individualized brokerage account, you lose your money. And if you lose your money, the bank doesn't have to give that back to you, and neither does the brokerage house. You made a bad investment, you lost your money, that's on you, right? So understand that the Security Investor Protection Corporation, SIPC, which covers investments in brokerage accounts, is not it doesn't work the same way as FDIC does. FDIC works in the event that the bank goes out of business and becomes insolvent. SIPC insurance works the same way, or if the brokerage house engages in fraud on your account. Now, SIPC will cover that, right? So SIPC will cover insolvency, SIPC will cover fraud, but SIPC won't cover you if you make a bad investment. So I need you to understand that your investments in an individualized brokerage account, or at any type of account that you have with a brokerage firm or a firm that's registered with the Commodities Future and Trading Commission, like those Forex accounts and all of that kind of stuff, and those commodities accounts and all of that, right? That stuff is not FDIC insured, and you need to know that. So I just wanted to disclose that, right? So that's very important. Now, so back to what I was saying about individualized brokerage accounts. There are no contribution limits, and there are no restrictions on withdrawing funds, right? But what are the drawbacks? So what are the drawbacks? So the money is taxed on the way in, and it's taxed on the way out. What does that mean, right? Okay, your money is taxed when you earn it, right? So state and federal taxes you pay on your income. When you get a check from work, you pay federal and state taxes. Ain't no way around that, right? So your money is post-tax that you're putting into an individualized brokerage account. It's called post-tax money. It's not pre-tax. It's post-tax. Now, if you make money with that money, like you make an investment, right, and you invest $1,000 and you make $1,000, right, you're subject to what's called a capital gain, it's capital gains tax. You're subject to a capital gains taxation on the $1,000 that you made in profit, right? So your tax going in, your tax going out. The government taxed you when they paid you. The government's going to tax you if you make money on that money in your individualized brokerage account, right? So these are some of the drawbacks, right? So understand that. So now, so with that in mind, now that we've talked about individualized brokerage accounts, right, now I want to get into the other type of investment accounts. And this is what Anna was talking about, right? So we're getting there now. Now we're getting into what are known as retirement accounts. So the first one we're going to talk about IRA. IRA stands for Individualized Retirement Account, right? Individualized Retirement Account. So let's walk into that. An IRA, or Individualized Retirement Account, an account designed to help you save for retirement, is an IRA, or an IRA, or an Individualized Retirement Account. Exactly what it sounds like. There are significant tax benefits to IRAs that help you keep more of your money. But there are also some rules on when you can withdraw your money and penalties if you do not follow these rules, right? So let's talk about some of the tax advantages. So tax advantaged accounts come with rules you need to follow. Here are a couple little rules to keep in mind when you're dealing with IRAs, right? So max contributions. So let's talk about max contributions in an IRA. In 2020, the maximum amount of money you can contribute to an IRA is $6,000. It's set that generally. Now it's $7,000 if you're 50 and older and using the catch-up contribution clause, right? Now, and that's annually. The This applies to both Roth IRAs and traditional IRAs. So you cannot contribute $6,000 into a traditional IRA and then go open a Roth IRA and contribute another $6,000. Now, it doesn't work like that. So you can't do that. It's $6,000 total. So, if you contributed $6,000 to a traditional IRA this year, don't try to go open up a Roth IRA. You can't do it. It ain't going to happen. You're going to get yourself in trouble. Don't do it. So, withdrawal rules. Money withdrawn before the age of 59 and a half. Remember, these accounts are set up for retirement. So these are accounts you're setting up to consider, your later years, your golden years, your winter years, right? So, it works like this. So that money's not for you now. That money's for you later, right? Every time I say golden years, I think of the Golden Girls. That's why I kind of pause there. I'm like, thank you for being a friend. Anyway, look. So look, money withdrawn before age 59 and a half has a 10% additional tax. So you pay 10% in additional taxes if you withdraw the money in an IRA, right? Before 59 and a half. That's the penalty. For Roth IRAs, this only applies to capital gains, not your original contribution. So that's the difference, right? So in traditional IRAs, right, you pay the additional 10% on the contribution and the capital gain. In a Roth IRA, you only pay it on the capital gain, right? You pay that additional 10% tax on the capital gain. So now here's the other thing, right? There are income limits. In order to invest in an IRA or a Roth IRA, there are some income limits here, right? So let's talk about that. Your ability to contribute to an IRA reduces and eventually goes down to zero if your income is above certain thresholds. If you are below the thresholds, you are clear. So let's talk about that. So for a Roth IRA, right? If you are single or filing separately from your spouse, the limit of income that you can have, the maximum income that you can have and continue to invest in a Roth IRA is $124,000 annually. That's your annual income. If you are married filing jointly, then the limit is $196,000, right? So if you're married filing jointly and you have an income threshold of $196,000 and below, or if you are married or single, or if you're single filing separately from your spouse, the limit is $124,000. So basically, if you're single, right, and you make less than $124,000 a year, you can invest in a Roth IRA, right? If you're married, you got to make less than $196,000 a year. If you're doing that, you can invest in a Roth IRA, right? So I'm going to get to that, Anna. Don't you worry. I'm going to talk about that. I'm going to get there. Give me a second. Traditional IRAs. If you are single or filing separately from your spouse on a traditional IRA, the income limit is $65,000. So if you're single or you file separately with your spouse, your income limit to invest in a traditional IRA is $65,000. If you make more than $65,000, you hit. If you are married filing jointly, then the limit is $104,000, right? So if you make more than $104,000, you hit. If you make less than $104,000, you can invest in a traditional IRA from a joint filing standpoint, right? Now here's the other thing. And we're walking into this. I told you we was going to walk into this. We're going to walk into this, Anna. Keep in mind that if you do not have a 401k or other corporate sponsored plan, your ability to contribute to a traditional IRA changes. But it does not affect a Roth IRA. So there are, and if you guys want, I can post it for your reading. There's a whole topic on retirements and required minimum distributions, RMDs, and all of that at irs.gov. I would be more than happy to post that for you guys, and anybody that wants to take the time to do the reading on that, I would encourage it. I mean, I would encourage it. When you're gonna think about retirement here, you're gonna consider these things. Okay, so there are several types of IRAs but the two most common are the Roth IRA and traditional IRA. Now we're going to dig into the Roth IRA a little bit, right? Let's dig into this. So Roth IRA. Roth IRAs are accounts that your post-tax income, that you can put your post-tax income into, right? But you can withdraw any capital gains tax-free when you retire, right? So when you hit that 59.5, point, right? That 59.5 joint, then you can take those capital gains out tax-free. In other words, you get taxed now by using post-tax income to invest, right? And get the benefit later when you pull out the money at a retirement tax-free, right? So when you retire, and this is the benefit of having a Roth IRA, right? So you invest the money, right, post-tax, because you got taxed on it, by your employer, well, by the state and the government, right, federal and state government, right? They tax your money when you got your check. And then you invested your money in an IRA. Cool thing about it is all the money that your IRA makes from the different investments that you invest in through your Roth IRA, right? That money now is all that growth. When you retire, you get to take it out of the IRA tax-free. You don't have to pay the capital gains tax on it. That's the cool thing about retirement accounts, right? But if you take it out early, then you got to pay the capital gains tax plus an additional 10%, right? So it costs to take that money out early. So if you're going to start an IRA, you're thinking for retirement. You put that money in there, you forget about that money. Don't go taking that money out because it's going to cost you a whole lot of money, right? So key benefits is you're not taxed on the way out, right? So again, right, if you hold it till retirement, of course, or that 59.5, right? That's the number. That's the golden number there, 59.5. So if you hold it to the 59.5, right? So you're not taxed on the way out. You're not subject to that capital gain taxation. There are no mandatory withdrawals. There's no mandatory withdrawal on this. So it's not like you hit 59.5 and they say you got to take all your money right now. No, you don't have to do that. You can withdraw your contributions anytime, although not usually recommended. It is a good safety net. You can withdraw your contributions at any time for a fee, for a nominal 10% and capital gains taxation plus an additional 10%. You're free to do that, right? But that's not recommended. Okay, what are the drawbacks to a Roth IRA? So there are contribution limits, which we talked about, right? 2020 to $6,000 a year is the maximum contribution that you can make to Roth IRA. So, or an IRA period. You pay a penalty if capital gains, you pay a capital gains penalty. So you pay an additional 10% plus the capital gains if you withdraw before the age of 59.5, right? So that's the drawback. You're taxed on the way in, obviously, because the state and federal government taxed your payroll check. So you got taxed on the way in. So those are the drawbacks, right? So we talked about the benefits, we talked about the drawbacks. Now let's talk about a traditional IRA. Let's dig into that a little bit, right? So traditional IRA is an account that you can contribute pre-tax income into. Pre-tax, right? But you get taxed on your contributions and capital gains when you withdraw. In other words, you benefit now by using pre-tax income and get taxed later when you pull your money out at retirement. Traditional IRAs are generally, and we're going to talk about that, traditional IRAs operate very similar to corporate-sponsored 401ks in that they use pre-tax income, right? Now, here's the thing. So, I'm going to come back to that in a second. So, key benefits. You're not taxed on the way in. Drawbacks. There are contribution limits, obviously, right? We talked about that. You pay 10%, a 10% penalty plus capital gains if you withdraw before the age of 59.5. There are mandatory withdrawals in a traditional IRA. There are mandatory withdrawals in a traditional IRA starting at 70.5. There are additional rules when you are utilizing corporate-sponsored plans, i.e. 401ks. You're taxed on the way out. Okay, so let's go into this, right? And I want to talk a little bit about traditional IRAs, right? So there are a lot of rules. So first of all, there are a lot of rules and drawbacks to keep in mind when dealing with these types of investment accounts. IRAs are extremely useful tools in helping you to save for retirement, but you just got to kind of understand, that there are some rules to this, right? Most people that have 401k, right, that are vested in their 401ks, if they lose their job or they quit their job, right, they're usually looking for a rollover, right? Something that they can roll over into, right? That's going to be able, so that way they can move the money from their corporate sponsored plan into another plan without getting hit on the taxation coming out and going in. Generally, you roll over to a traditional IRA, right? That's generally what you're rolling over into, right? That rollover allows the money to continue to be pre-taxed, so you don't get taxed going out and coming in, right? So that's what, when you hear people talking about rolling over 401ks, that's what they're talking about. They're talking about rolling their investment from their corporate sponsored plan to an individualized retirement plan, right, for themselves. So now I'm going to get into 401k now. Now let's talk about 401k, right? So, I know, Anna, you had a question. Spotty, I think you just answered a question right here. Yeah, if y'all just let me get through the end, I think I might be able to get most of y'all questions out the way. So let's talk about 401k, right? A 401k is a corporate sponsored account provided by your employer. As mentioned above, a 401k is similar to a traditional IRA. It offers a tax break on your income now, and you are taxed on your money later. With 401ks, you designate a percent of your income from your paycheck that you want to contribute, and it is automatically deducted and invested for you based on your pre-selected investment vehicles. Now, Anna, this is now we're getting into the question that you were asking about, right? See, most 401ks are managed by, there's like a fund manager, right? Or a 401k manager. You might have John Hancock, you might have BlackRock, you might have Fidelity, and with that in mind, what they do is they are your employer is like the plan sponsor, right? So they're the plan sponsor, but again, they're not a professional investment money manager. That's not what they do, right? So they bring in a John Hancock or a Fidelity or a BlackRock to come in and manage their 401k plan, contribution plan. So what happens is, now, because 401k investors, because we understand that 401k investors are generally tend to be consumer-based contributors who are saving for retirement. When you log into your Fidelity or your BlackRock or your John Hancock portal, right, you get to see how much money you've contributed to your 401k plan. The other thing you get to do is choose your risk appetite. Are you moderately risky? Are you conservatively risky? Are you an aggressive investor? And based on what you pick there, then Fidelity or BlackRock or John Hancock, whoever's managing your corporate 401k plan, right, will give you a list of options that you can pick to invest in. Different types of funds, different types of stock portfolios, etc., etc., etc. So your money that you're contributing to your retirement plan is being invested then into different types of investments based on what you've selected in your investment portfolio. And that can change month to month. You can go in the next month and change your risk profile, change your investments, etc., etc., etc. If you see that your investments are stock heavy because you picked stock heavy investments, 6 months ago, you see the stock market's not doing good, you want to start moving that money into more of a bond heavy type portfolio management investment, you can do that, right? So that's what they have that portal for. Now, so what really, when you really look at it, right, a 401k account or a 401k investment is like an individualized brokerage account. It's just you have a professional money manager managing your investments and giving you options to pick from, right? And you can't withdraw it at any time because there's penalties to do that. It's a retirement account, right? So that's how, I think, Anna, I hope I answered your question there, right? Because we got to that point finally. I hope I helped you understand what the underlying investments are in your 401k and why you have underlying investments and how that part really works out, right? So let's talk a little bit more about this. The largest benefit of a 401k is the employer match, right? In short, some companies contribute a certain percentage of your income to your 401k in addition to your contributions, as long as you met certain contribution thresholds. The most common example is companies matching 50% of the first 6% you contribute. So let's talk about an example of that. You contribute 3%, your employer contributes 1.5%, you get an investment of 4.5%. So you invested 3% of your money. The company came in and said, hey, we're going to give you 1.5% of ours to match you. And your total investment is 4.5%, right? And it's a happy day. If you contributed the full 6%, right, of your paycheck on an annual basis to your 401k, then your company's going to match that 3%, right? So that's a really cool thing because your company is boosting your retirement investment savings, right? So that's a very helpful thing. You know, when you consider working at companies, you know, if you're going to go the employee route, you might as well work at a company that's going to do some profit share. Dollar matching or investment matching at least. That's important. Match program. You know, the other thing is, you know, what I like to look for, like what I would recommend that you guys be looking for, right, is matching and profit sharing. You want to match and a profit share. But that's another conversation. Now, there are a few rules to keep in mind with 401ks, right? There's max contribution, of course. The max contribution for any individual is $19,500 annually. Annually. While the max contribution for the individual plus the employer is $57,000 annually. You want to work at a company, right, that if you are investing the $19,500, you want to find a company that's going to make up the difference and allow you to get to that $57,000 a year, right? So now, again, there are withdrawal rules to your 401k as well. Money withdrawn before the age of 59 and a half has a 10% additional tax, right? So you pay an additional tax on that money if you withdraw it early. Mandatory withdrawals, similar to traditional IRAs, you must start withdrawing from the plan at age 70 and a half to avoid penalties. So at age 70 and a half, you have to take withdrawals or distributions from your 401k plan, like a traditional IRA. And if you don't, you start getting hit with penalties. Now, let's talk about some key benefits here. Key benefits of your 401k are very simple. Number one, you're not taxed on the way in, right? The employer matches your contributions, right? If you work at the right employer, they're matching contributions. It's automatically deducted from your paycheck, and because it's automatically deducted from your paycheck, it's pre-tax, which is great. What are the drawbacks? Of course, there are contribution limits. There are penalties if you withdraw before age 59 and a half. And mandatory withdrawal starting at age 70 and a half. You are taxed on the way out. It is a limited investment vehicle option. Typically, there are only a handful of mutual funds to choose from when investing in a 401k versus the unlimited options when investing through a broker or an IRA or personal brokerage account. Now, let's talk about a couple of things, right? Now, the other types, and before I get into that, the other types of corporate-sponsored accounts are pension plans, right? 403Bs, 457s, solo 401ks, SEP IRAs, and simple IRAs, right? So, you know, if you have one of those and you want to talk to me about that offline, feel free to DM me, and I have a conversation with you about that stuff, right? But, you know, the average person doesn't run into 403B, 457, solo 401k, SEP IRAs, or simple IRAs. So, I'm not going to go into that right now because, you know, that's not really, you know what I mean? Like, most people don't see it. Now, let me talk about something. There is a way to access your 401k funds earlier while ducking that 10% penalty. There is a way to do it. It's called a policy loan. Some companies allow it, some companies don't. but some companies will allow you to call your 401k manager, like your BlackRock, your Fidelity, your John Hancock, and take a policy loan against your 401k. And essentially what you're doing is you're borrowing money against the 401k, and so they're going to collect the money out of the 401k plus a fee for doing that. But it's going to be lower than the penalty that you would have taken if you had to just directly access the funds, right, with an early withdrawal, an early distribution, right? So there is a policy loan option in the 401k that you can look into if you're trying to start a business or invest in real estate or do things like that, right? There is an option for that. You know, it's called a policy loan. You know, call your plan manager, your Fidelity, your BlackRock, your John Hancock, whoever's managing your plan. Call them and ask them about policy loan, right? And if that's possible and something that you're allowed to do is take a policy loan, right? So, you know, that's that. Now, so I think I covered everything I wanted to cover in that. The next thing I want to talk about are 529 college savings plans. How do you 401k yourself with your own business? Haha. Anna, that's a great question. Give me a second. Let me get to the end of this, and then I'll talk about that a little bit, right? Okay, so, and I was going to get into that when I got into corporate structure anyway, but I'm going to kind of get into that with you, right? So give me a second. Let me finish this up. Okay, so the next type of account that I want to talk to you about is what's called a 529 college savings account. 529 college savings account. If you have kids and you don't have a 529 college savings account set up for them, you're wrong. You're wrong. You are wrong. You need to go out tomorrow. Tomorrow is Monday. You need to go out tomorrow and you need to go get you a 529 college savings account for all your kids. All of them. If you got kids, they need to have 529 college savings accounts, period. Let's talk about why. So, 529 savings accounts, the educational savings plan, right? This account is designed to help save for a beneficiary's higher education, college, and includes generous tax benefits. Now, benefits do vary slightly by state, right? But there are very generous tax benefits to this. Key benefits, they're not taxed on the way out. You can use it at most schools nationwide. It's not just limited to certain states. Some states offer matching programs. So if you got $50,000 in the fund, right, in a college savings plan, and your kid is in a state and he's going to a state college, the state may match that and put another 50 on it. Know what I mean? So if you don't have college savings plans for your kids, you're wrong. Drawbacks. Limited to only use on education expenses for the beneficiary. And they're taxed on the way in because, of course, you're putting post-tax dollars in there. You're putting dollars you got from your check into the account, so it's post-tax. But at the end of the day, it's limited to education expenses. But guess what? That was the whole purpose of setting up the plan anyway, was to pay for their college. It is very important, and it is a very smart money management strategy and long-term, long-range legacy play to set up 529 college savings plans. You don't know how many times that I've heard stories in our community about kids who were smart enough to get accepted, but their GPA wasn't right to get a full scholarship, right? It wasn't good enough to get a full scholarship, and parents couldn't afford it, and so they couldn't go to that top-tier Ivy League school. They had to go to a second-rate school or go to a junior college because their parents just couldn't afford to make up the difference. Had they have contributed to a 529 plan every single month, though, from the time that child was born up until the time that child graduated, there'd have been more than enough cash flow to be there, especially if they decided to go to a state school in a state that matches. See what I'm saying? It's about long-range planning. Wealth is built over a lifetime. It's built over a lifetime. But you got to make the strategic steps. You got to be banking money every step of the way. You have to. You have to. You got to be thinking long term with this stuff, right? So, okay. So, I wanted to cover the other types of accounts. So, the other types of accounts that you can make, and I'm just going to run through this real quick, right? Cryptocurrency accounts. If you want to invest in cryptocurrency, you have to open a specific account for that. And that's with a cryptocurrency firm like Coinbase. Like, I recommend Coinbase. Because Coinbase is US based, they're regulated, they're very well respected, they're very, very credible. You don't have to worry about them closing shop and running away with all your coins. Coinbase. Okay, Coinbase.com. If you want to invest in the Forex market, you have to open a trading account, like a brokerage account, with a firm that is registered with the Commodities Future and Trading Commission, right? That's to trade currency and commodities. So I just want to point that out, right? So that's it. Today's not the conversation for a whole detailed conversation on cryptocurrency, so I'm not going to do it. And in my opinion on Forex, for the average person, you shouldn't be investing in Forex. I'm going to just leave it at that, right? There's going to come a time where I'm going to go into extreme details of why that is, right? But today is not that day, right? Now, just a heads up, cryptocurrency has no intrinsic value. There's nothing underlying and tying to it. It's highly volatile. If you do not understand how cryptocurrency works, it ain't for you. You can make a lot of money in cryptocurrency. You can. That's a fact. If you understand how to read the markets. If you don't understand how to read the markets, or the fact that those markets are moved by purely fear and greed, and there's no intrinsic value underlying the coins, right? There are very few stable coins in the market. If you don't understand that, this ain't for you, right? But I'll have a discussion on cryptocurrency at a later time. I'm going to go into the full details of cryptocurrency, what makes it work, what blockchain is. I'm going to talk about all that stuff, but that's going to be at a later time, though. Now, I'm rushing a little bit because I only got a few minutes left. Okay, and you asked me a question, Anna, about how it is that if you start a business, you can 401k yourself. So first of all, when you start a business, you have to make yourself an employee of the business. And I'm going to talk about this more when I talk about corporate structure, right? That's in 2 weeks, right? I'm going to talk about fractionalized reserve banking next week, and I'm going to start talking about corporate structure the following week, right? But so you essentially make yourself an employee, right? And then you go up to John Hancock, because that's the one of, usually when you're a startup to mid-tier, you usually go to John Hancock to manage your 401k plan, right? So you're going to go to John Hancock. You want to have, it's better if you have like 2 employees, right? But at 2 or better, right? But you can do it with 1. Go to John Hancock, tell them you want to set up a 401k plan. And then they're going to talk you through, and they're going to ask you questions, and you're going to think about some things. Do you want to match in dollar share? Match and profit share? Do you just want to match? What level do you want to match? All of these things, and then you're going to begin to structure a 401k policy, right? And that 401k policy is something, there may be vesting limits, right? So if you set up vesting limits, right? So, okay, you're not vested for a year. You have to be working at the company for a year to be vested, etc., etc. A lot of things that go into it, but yes, you first have to be an employee of your company, right? Which means you have to be drawing a payroll check. You have to be a W-2 employee of your company to be able to participate in the 401k plan, right? Because it's for employees. So, you're not a managed member. You're not a managed member. No, you are an employee. You're an employee. You have a job title. You have a job description. You draw a paycheck that you pay taxes on, that the company pays taxes on. That has nothing to do with your shareholder distribution, though. You can be both. You can be the owner, the shareholder, and an employee. You can be all of that. But we're going to get into that when we get into corporate structure. I was just giving you an overview right now. But we're going to have this discussion again when we get into corporate structure, when we get into business planning, when we get into scaling, when we get into how you grow a business, how you develop a business, the things you got to consider, all of those things. We're going to revisit these discussions again. So guys, unfortunately, I ran the whole hour this time, so I can't take questions today. I'm so sorry about that. Like, I was trying to, I was trying to, leave some time for questions. It didn't work out, though. I'm sorry. It was a lot of information to cover, right? So, as always, like, subscribe, share, follow. I think I'm going to make a song up like that. Like, yo, like, subscribe, then share, and follow. Yeah, I'm such a nerd. Like, that ain't going to work out. Anyway, yes, listen. Like, subscribe, share, follow. Tell anybody that that could benefit from this information. The more eyes we get on this information, the more people can benefit from this information. As always, is hashtag for the free. Hashtag we get real woke around here. And hashtag we make it make sense. Alright, y'all? So I will see y'all next Sunday, 3 p.m. Eastern Standard Time, when we're going to talk about fractionalized reserve banking. Alright? You guys have a great day.
Oh, no, it ain't a problem. Not a problem. I appreciate y'all too. I think it's just gonna stop on its own, so I'm gonna just hang out with y'all, cause I can't even get to the exit button at this point. It's 10, 9, 8, 7. Yo, y'all have a good day. All right, I'll talk to y'all later. Bye.